Welcome to the Knakal News Network. The Knakal News Network is brought to you by the Knakal Group, Cushman & Wakefield's #1 investment sales team in New York City.
So, going into this year, the two biggest questions were, okay, we came off this fantastic year, we had a cyclical peak in the number of properties sold, dollar volume was very high. Is the market in a bubble? Is it going to burst? Will this market continue? Will it continue to run? So coming into this year, our forecast was, we believed that the dollar volume of sales would hit an all-time record, mainly because property values were increasing so sharply. And we said the number of properties sold was going to decrease. And why is that? Because the number of sales was so high in 2014 that over time you have to regress towards the mean for the long term. And we also said we've never seen two record years in a row with respect to the number of properties sold. So we thought that would be the case. We also thought values would rise about 10 or 15%. This is one chart, if you've heard me speak before, you know I love this chart. This is Manhattan turnover going back to 1984. Those are the blue bars. And you look at 2014, you say, well, what year was this like in the past? And I've often equated 14 to 1988 and 1998. Those were years in which we also had a cyclical peak in the number of properties sold. And if we drill down and look at this period, which is back in 86, we had tax reform. It spiked the number of properties sold. The turnover ratio, that's 3.4% out of the 27,649 buildings in New York south of 96th Street. Volume dipped in 87 and then hit its cyclical peak in 88, very similar to what happened in 2012, 2013, and 2014. We look at another period of time with a cyclical peak, 1998. Capital gains taxes dropped from 28 to 20%. People went crazy, sold everything. You had a lot of stuff on the market. Then you had a dip in 99, another spike in 2000. But in this case, in 1988, we had a number of clients who said, the market's too overheated, prices are too high, we don't think the market can sustain itself. We had been at that point 5 years into a run, well, we're 5 years into this run. And in 1998, I had a number of clients who said, you know what, Bob, I'm going to sit on the sidelines, I'm not going to buy anything, it's too frothy. Well, if those folks sat on the sidelines, they would be sitting there for 9 years because the market kept its upward trajectory with respect to values through 2007. If we look at turnover through, this is that extended period of time going back to after the S&L crisis. This extended period of time leading up to 98 led folks to think that 98 was going to be that year in which things would turn, market would correct. It didn't happen, it ran for another 7 years. So if we look at today, where are we? We see that through the first 3 quarters of the year, 55 billion, almost 56 billion in sales, only 2 billion short of last year's entire total. If we annualize that amount, you'll see that we're on pace for nearly $74 billion in terms of the dollar volume of sales. That blows away the past record in 2007. Is a great clip above where we were in 2014. So dollar volume is about where we had anticipated it would be. We had actually projected about 65 billion, which we thought would set a new record, but it's just really been off the charts. But interestingly, annualizing the first quarter, we would have been at 80 million. Annualizing the first half of the year, we would have been at 77. Now we're at 74. We'll see how the fourth quarter turns out, but we still feel pretty good about our initial projection. In terms of dollar volume in Manhattan, which is the market that we consider the bellwether, also on pace for an all-time record year of over 56 billion. We look at Northern Manhattan. Northern Manhattan is the one sub-market that for the past 2 years has been the market that has performed the best in terms of its appreciation, in terms of its activity. This year, taking its lumps a little bit. Brooklyn is on pace for almost 9 billion in sales. That's just incredible, but that's a testament to the different types of properties and the better quality properties that are in Brooklyn today and the value appreciation that we've seen there. In Queens, also on pace for an all-time record. And in the Bronx, again, this is very consistent throughout, all-time records. Now this chart breaks down the dollar volume by quarter. And you look at the first quarter of 2015, over 20 billion in sales. First time that's happened, even surpassing the great fourth quarter of 12 that we had and the first quarter of 2007. And this period of sustained activity is among the best that we've ever seen. We look at the number of properties sold, we see through the first 3 quarters about 4,000 compared to last year's 5,500. And we annualize that, we're at about 5,264 for the year, not quite a record, but again, where we anticipated, it's actually a little better than we had anticipated. Manhattan, not going to come close to the 1,200 properties that sold in 2012. In Manhattan in 2012, so many people rushed to beat the anticipated increase in capital gains taxes that we just had an unbelievable year, but still, the second best year within the past 34 years is going to be this year. Northern Manhattan, again, down a little bit. Brooklyn, about even. Queens, not going to be quite the 1,234 we had last year. And the Bronx will see a little bit more activity than we had last year. Now, if we go back to this period, this is quarterly activity. And again, this period of time, going back to the 3rd quarter of 2013, this has been the best sustained activity that we've seen in the past 32 years. It's really been remarkable. So if we look at what's happened with the number of properties sold being down a little bit and the dollar volume being up so much, we see that the average price of a property sold in the city has hit an all-time record, approximately $14 million. That has been tremendous for the brokerage industry because every deal is a lot more valuable now, but just a great thing for the marketplace in general. So if we look at values, we'll look at cap rates first. Cap rates you see citywide, you see this very convex kind of curve. They're going down at an increasing rate to the point where this year cap rates 4.73% on average citywide. That is incredibly low. It's the first time it's been below 5% in our recollection. Manhattan cap rates, though, look at this. This is a little different. This is a little bit more concave, right? It looks like the compression of cap rates is slowing down a little bit. Still, the average cap rate in Manhattan, 3.85%. I mean, that is just a remarkable number relative to what history has been and where we were. You look almost 6% back in 2010. Northern Manhattan, you're going to see the same thing, market by market, cap rates going down, Bronx even lower. New York City, you see the Bronx has the highest average cap rate at 6.2%. 3.83 average in Manhattan. And by property type, no surprise, elevator buildings, the lowest cap rate, elevated apartment buildings at 4.15, and we have retail properties just a shade under 5 citywide. Again, remarkably low cap rates. So if we look at prices per square foot, we see that they have also increased very, very nicely over time. We're currently averaging almost $500 a square foot in New York City, and if we look at this chart, the dark blue bars are Manhattan, the light blue are the outer boroughs. And if you look at the light blue bars, you see a steady rise in average price per foot, but in Manhattan, we have this drop. And that is mainly because of retail properties, and I'll explain that in a second. If we look at Manhattan again, the average is lower. Does that mean that values have dropped in 2015 from 2014? Not at all. It all has to do with the mix of properties that are within the sample that have sold. You look at Northern Manhattan, new record. Brooklyn, new record. Queens, new record. Bronx, new record. So let's look at product types because this will explain why we had that drop in average price per square foot in Manhattan last year. So elevator properties per foot up to almost $500. Walk-ups, high. Retail properties. Now, New York City, look at that average. That's a very significant drop. But it's explained by this chart. You look at the top 5 retail properties sold in 2014, that average is probably around $15,000 or $16,000 a square foot, right? You look this year, the highest price, $6,600 for 85 Fifth. Happened to be one of our transactions, but if you look at this and you see these, which are remarkably high per square foot, but they don't compare to what was going on in 2014. And transactions that are occurring at such high prices per square foot can skew the numbers. So if you look at that chart of average price per square foot, you would think Manhattan is having a tough year. It's really not. It's because of the mix of properties that have sold. If you look at New York City office buildings, You see the average is up to about $772 a square foot. Development sites, almost $300 a buildable foot citywide.